Listen carefully to what I'm about to tell you because I've spent 5 decades studying economic cycles, and what I'm seeing right now keeps me awake at night. Not because I'm afraid of losing money, but because I know what's coming, and I know that most people are positioned on the wrong side of the greatest wealth transfer in modern history. I've seen this pattern before. I studied it in the 1920s and 30s. I watched it unfold in 2000. I lived through it in 2008. And I'm telling you right now, with every metric I track, with every indicator that matters, we are approaching something bigger than all of those combined. The crash that's building for 2026 won't just be another correction. It will be a complete restructuring of who owns what in this country. And here's what you need to understand. I'm not sharing this information to scare you. I'm sharing it because there's still time to position yourself correctly. There's still time to move from the side that loses everything to the side that profits beyond what seems possible. But that window is closing, and it's closing faster than most people realize. Let me start by telling you something that took me decades to truly understand. Markets don't crash randomly. They crash predictably. They follow patterns that have repeated throughout human history because they're driven by fundamental forces that never change: debt cycles, credit expansion, human psychology, and mathematical inevitability. Once you understand these forces, crashes stop looking like unexpected disasters and start looking like scheduled events that you can prepare for and profit from. At Bridgewater, we've built our entire approach around understanding these cycles. We call it the all-weather strategy because it's designed to perform regardless of what economic environment we're in. But here's what most people don't know. The real money isn't made by performing okay in all environments. The real money is made by positioning aggressively for the major transitions, and we're approaching the biggest transition I've seen in my entire career. Right now, the Shiller price to earnings ratio is sitting at levels we've only seen twice before in history. Once in 1929, right before the crash that started the Great Depression, and once in 1999, right before the dot-com bubble burst and destroyed trillions in wealth. Do you understand what I'm telling you? We're at valuation levels that have only existed at the peaks of the two greatest bubbles in American history. But here's where it gets more interesting. In 1929 and 1999, we only had one major bubble. Stocks were overvalued, but other assets were more reasonably priced. Right now, we have simultaneous bubbles in stocks, real estate, bonds, and even cryptocurrencies. The entire financial system is inflated beyond any historical precedent. When this unwinds, and it will unwind because mathematics demands it, the magnitude will dwarf anything we've experienced before. Let me walk you through the mechanics of what's happening, because if you understand the mechanism, you can position for the outcome. Since the 2008 financial crisis, central banks around the world have printed more money than was created in all of human history before that point. Think about that. More new money was created in the last 15 years than in the previous 5,000 years of civilization combined. That money didn't just disappear. It flowed into asset prices, creating the everything bubble we're living in right now. Stocks went up not because companies became more valuable, but because there was more money chasing the same number of shares. Real estate prices soared not because homes became more useful, but because cheap mortgages and investor speculation drove prices beyond what working families could afford. Even bonds, which normally provide safety during uncertain times, became overvalued as central banks purchased them directly to keep interest rates artificially low. Now, here's the problem. That artificial support is ending. The Federal Reserve has started raising interest rates because inflation finally got so bad that they had no choice. European and Japanese central banks are following the same path. The free money era is over, And when free money ends, asset prices that were only justified by free money have to adjust. That adjustment is what we call a crash. But let me be very clear about something. This crash isn't going to destroy wealth. It's going to transfer wealth from people who are positioned based on recent experience to people who are positioned based on understanding historical cycles. From people who believe that what went up will keep going up to people who understand that what goes up beyond fundamental value must come down. From the unprepared to the prepared. I've been tracking Berkshire Hathaway's cash position because Warren Buffett is one of the few investors alive who has the same historical perspective that I do. Right now, Berkshire is sitting on over $300 billion in cash. That's not a typo. $300 billion, the largest cash position in the company's history, more than they held in 2007 before the housing crash, more than they held in 1999 before the tech crash. Buffett isn't building this cash position because he's afraid. He's building it because he knows what's coming and he wants to have maximum firepower when assets go on sale. At Bridgewater, we're doing something similar, though our approach is more nuanced because we manage money for institutional clients who can't simply hold cash and wait. We're rotating out of overvalued growth stocks and into positions that will maintain value during the deleveraging phase. We're building positions in assets that will benefit from the monetary and fiscal response that will inevitably follow the crash. We're preparing our portfolios for an environment that most investors think is impossible, but that history tells us is inevitable. Let me tell you about the debt cycle, because this is the most important concept for understanding what's coming. Economies run on credit, and credit expands and contracts in predictable waves. During the expansion phase, borrowing becomes easier, and people take on more debt. That debt fuels spending, which looks like prosperity. Asset prices rise because people are using borrowed money to buy them. Everyone feels rich because their homes and portfolios are going up in value. But debt has to be paid back, and when debt levels get high enough, the burden of servicing that debt starts to overwhelm the system. People who borrowed too much begin to default. Lenders who made too many risky loans start to fail. Asset prices that were inflated by easy credit begin to fall. And once the process starts, it feeds on itself. Falling asset prices create more defaults. More defaults create stricter lending standards. Stricter lending creates less spending. Less spending creates falling prices. The cycle reverses, and the reversal is always faster and more violent than the expansion was. We are at the peak of the debt cycle right now. Corporate debt has reached levels that would have been considered insane just 20 years ago. Government debt in the United States alone has gone from $10 trillion in 2008 to over $30 trillion today. Consumer debt for credit cards, auto loans, and student loans has reached record levels. The entire system is leveraged beyond anything sustainable, and the deleveraging is about to begin. When I say deleveraging, I mean the process where debt gets reduced either through defaults or through inflation. Both paths transfer wealth, just in different ways. Defaults transfer wealth from creditors to debtors who walk away from their obligations. Inflation transfers wealth from savers to borrowers by making the debt easier to pay back with currency that's worth less. The government and Federal Reserve will try to manage this process to minimize pain, but the mathematics are brutal. The debt is too large to be grown out of, so it has to be defaulted on or inflated away. Either way, the wealth transfer will be enormous. Now, let me tell you where the opportunities are, because this is why I'm making this information public. I believe that financial literacy is crucial for a functioning society. And right now, most people are positioned completely wrong for what's coming. They're going to lose wealth they spent decades building unless they understand these patterns and reposition accordingly. The first thing you need to understand is that cash becomes extremely valuable during the deflationary phase of a debt cycle, not because cash grows in value, but because everything else falls in price. The purchasing power of cash increases dramatically when asset prices collapse. This is why Buffett is holding $300 billion. This is why Bridgewater maintains significant cash positions during late-stage bubbles. We want to have firepower when everyone else is forced to sell. But timing matters enormously. Holding cash too early means missing gains and earning nothing while waiting. Holding cash too late means you don't build enough of a position to capitalize on the opportunities. The key is watching the indicators that signal we're approaching the transition point. Right now, those indicators are flashing red across multiple dimensions. Manufacturing activity has started to contract. The yield curve has inverted, which has preceded every recession in modern history. Credit spreads are widening, meaning that lenders are starting to demand higher interest rates for risky loans. Consumer confidence is beginning to crack, even though the unemployment rate remains low. These are the early warning signals that appear before the crash becomes obvious to everyone. The second thing you need to understand is which assets will survive the crash and which will be destroyed. This is where most people get it wrong. They think diversification means owning a little bit of everything. But during a debt cycle peak, most assets are overvalued together. True diversification means owning things that will maintain value when credit contracts and asset prices fall. Quality companies with strong balance sheets, low debt levels, and consistent cash flow will survive and eventually thrive. These are businesses that don't depend on continued access to cheap credit to operate. They generate real profits, they return cash to shareholders, and they provide products or services that people need regardless of economic conditions. When these companies go on sale during the crash, that's when generational fortunes are built. I want to give you some historical perspective on what this looks like in practice. During the 2008 financial crisis, Amazon stock fell from $100 per share to $35. Apple fell from $200 to $80. Google dropped by more than half. These weren't failing companies. They were world-class businesses, temporarily mispriced because everyone was panicking and forced sellers were dumping everything they owned. The investors who recognized this disconnect and had the cash and courage to buy during that period didn't just preserve their wealth. They multiplied it by 5 times, 10 times, even 20 times over the following decade. Amazon went from $35 to over $3,000. Apple went from $80 to over $150 after multiple stock splits. Google increased by more than 10 times. The opportunity was obvious in hindsight, but it took courage to act when fear was at its peak. Real estate follows a similar pattern, but with important nuances. Not all real estate maintains value during crashes. Properties in declining areas or built on speculation often become worthless. But prime real estate in locations with strong fundamentals, properties with good cash flow and low debt, these assets maintain their utility even when prices fall. And when prices do fall by 30, 40, or 50%, that's when you can acquire assets that will generate income and appreciation for decades. Let me tell you about a principle that governs all of this. In markets, price and value are two different things. Price is what you pay, value is what you get. During bubbles, price rises far above value because psychology and momentum take over. People buy because prices are going up, not because the underlying asset is worth more. Eventually, this gap becomes so large that it has to close. When it closes, price falls back to value and usually overshoots below value because fear becomes as extreme as greed was. This overshoot is where fortunes are made. When fear drives prices below intrinsic value, You can buy assets that will generate returns far beyond anything possible during normal markets. A company worth $50 per share that drops to $20 during panic isn't just a good deal, it's a wealth-building machine. Real estate worth $500,000 that sells for $200,000 during forced liquidation isn't just a bargain, it's a legacy asset. The challenge is psychological. Every instinct you have will be telling you to do the wrong thing at the wrong time. During the bubble phase, when prices are high and rising, social proof makes you want to buy. Your neighbors are getting rich, your colleagues are bragging about their portfolio gains, and financial media is proclaiming that this time is different. The pressure to participate is enormous, even though that's exactly when you should be building cash and preparing for the crash. Then when the crash arrives, every instinct reverses. Prices are falling, media is predicting the end of capitalism, and everyone around you is panicking. The pressure to protect whatever you have left is overwhelming, even though that's exactly when you should be buying aggressively. Success in crash investing requires you to act in opposition to your instincts and in opposition to social proof. This is why I develop principles-based decision-making. Principles are rules that help you do the right thing even when it feels wrong. One of my core principles is that the consensus is usually wrong at extremes. When everyone agrees that markets will keep going up, that's when they're most likely to crash. When everyone agrees that it's too dangerous to invest, that's when the best opportunities exist. By following this principle mechanically, you can override the emotional responses that destroy wealth. Let me talk about gold and precious metals, because this is an area where many people get confused. Gold doesn't make you rich. Gold preserves purchasing power when other forms of wealth are being destroyed. Throughout history, when currencies lose credibility and financial systems break down, gold maintains its value because it can't be printed or created by governments. It's insurance, not an investment. During the 2008 crisis, gold went from $700 per ounce to over $1,900 as investors lost faith in paper assets and central banks printed trillions of new currency. People who held gold didn't become rich, but they maintained their wealth while others saw their portfolios cut in half. That preservation of capital then gave them the purchasing power to buy crashed assets at the bottom. I recommend that everyone hold some gold as insurance, typically 5 to 10% of their portfolio, not because I think it will make you rich, but because it provides protection against the tail risks that can destroy wealth. If the dollar loses reserve currency status, if inflation spirals out of control, if the banking system faces another crisis, gold will maintain value when other assets fail. It's a hedge against catastrophic outcomes. Now, let me address the timeline question, because everyone wants to know exactly when this will happen. The honest answer is that I don't know the precise timing, and anyone who claims to know is lying or delusional. What I can tell you is that we're in the late stage of the cycle based on every indicator I track. The crash could start next month, or it could take another 2 years to fully develop, but the setup is clear and the outcome is inevitable. Rather than trying to time the exact top, the better approach is gradual repositioning that accelerates as warning signs intensify. Start building cash now, even though it means missing some of the final gains of the bubble. Start researching quality companies and real estate that you'd want to own at the right price. Start preparing your psychology for acting when fear is at its peak. These steps don't require perfect timing. They just require recognition that we're closer to the end than the beginning. I want to tell you about something we do at Bridgewater that has proven incredibly valuable over the decades. We conduct scenario analysis where we map out different possible futures and determine how our portfolio would perform in each scenario. Right now, we're running scenarios that include deflation, stagflation, outright depression, and various paths of recovery. By understanding how different assets perform in each environment, we can position to profit regardless of which path unfolds. For individual investors, you can do a simplified version of this. Ask yourself what happens to your portfolio if stocks fall by 50%? What happens if real estate prices drop by 40%? What happens if inflation runs at 10% per year? What happens if we enter a decade-long stagnation like Japan experienced? If your current positioning would destroy your wealth in multiple scenarios, you need to reposition. The goal is to survive all scenarios and thrive in at least some of them. Let me talk about something that most people completely miss. The recovery phase after a crash is often where the greatest wealth is created, not during the crash itself. The crash destroys weak competitors, resets valuations to attractive levels, and creates opportunities for strong players to gain market share. Companies that survive the crash emerge stronger, with less competition and better positioning. Real estate investors who buy during the crash can acquire multiple properties that generate income for decades. But here's the crucial point. You can only participate in the recovery if you survive the crash with capital intact. The investors who bought at the bottom in 2009 weren't just lucky. They had preserved capital during the bubble years and had the discipline to deploy it when everyone else was. Panicking. That's the strategy. Preserve capital now, deploy aggressively during the crash, and then ride the recovery wave to generational wealth. I want to address a mistake that many people make when they hear this information. They sell everything, go entirely to cash, and wait for the crash. This is usually wrong because timing is so difficult and because you give up all the gains that can occur during the final phase of the bubble. The better approach is gradual repositioning. Reduce exposure to the most overvalued assets. Build cash positions slowly. Maintain some exposure to quality companies that will survive the crash. This balanced approach lets you participate in upside while protecting against downside. The institutional investors I work with at Bridgewater can't simply go to cash because their mandates require them to stay invested. So we use more sophisticated approaches. We reduce equity exposure and increase positions in assets that benefit from volatility. We use options strategies that profit from market dislocations. We maintain positions in treasury bonds that will rally when fear peaks. These approaches are more complex, but the principle is the same. Reduce risk now, prepare for opportunities during the crash, and position for the recovery. Let me tell you about the role of government and central banks in this process, because their response will create additional opportunities. When the crash begins, politicians and central bankers will panic. They'll implement emergency measures to stop the bleeding. Interest rates will be cut to zero or below. New money will be printed on a scale that makes previous programs look tiny. Fiscal stimulus will flow to politically connected industries and constituencies. These responses create inflation, which benefits holders of real assets, while punishing holders of cash and bonds. So the strategy has phases. During the bubble, build cash. During the crash, deploy cash into quality assets at distressed prices. During the recovery, hold those assets as government stimulus creates inflation that drives prices higher. Each phase requires different positioning, and success comes from understanding the cycle and adapting your strategy accordingly. I need to address something that concerns me greatly. The wealth gap in America has reached levels that are socially and politically dangerous. When crashes occur, this gap widens because sophisticated investors profit from the chaos while average families lose their homes, their jobs, and their savings. This creates resentment and political instability that can lead to policy changes that affect everyone's wealth. I don't have a solution to this problem, but I do think it's important to understand that your wealth preservation strategy needs to account for political risk. Wealth taxes, capital controls, and property confiscations become possible when populations are desperate and angry. Diversifying across jurisdictions, maintaining some assets outside the traditional financial system, and staying politically aware are all prudent steps. The international dimension of this crisis deserves discussion because the United States isn't experiencing this debt cycle alone. Europe, Japan, and China all have their own debt problems and asset bubbles. When the crisis hits, it will be global, but different countries will be affected differently, and those differences create opportunities. Currencies will move dramatically relative to each other. Some countries will implement more effective responses than others. Some assets will be in jurisdictions with better rule of law and property rights. I've been studying Chinese debt levels with particular concern. Their property market is already showing signs of stress, with major developers defaulting on obligations. Their banking system has hidden non-performing loans that could trigger a cascade of failures. Their demographic situation, with a rapidly aging population, makes their debt burden even more unsustainable. When China's bubble bursts, and it will burst because the mathematics demand it, the global implications will be enormous. But here's the opportunity in that crisis. When Chinese assets crash, they'll create buying opportunities in the world's second largest economy. Real estate in prime locations, shares in quality Chinese companies, and positions in industries that will dominate the future will all be available at distressed prices. The investors who have studied China, who understand which assets have real value, and who have the capital and courage to act will build positions that generate returns for decades. Let me tell you about a principle that has served me well throughout my career. When everyone is thinking the same thing, everyone is likely to be wrong. Right now, the consensus view is that central banks have everything under control, that technology will keep driving productivity gains that justify high valuations, and that the economy can continue growing indefinitely on cheap credit. This consensus feels comfortable because it's what most people believe and what financial media reinforces daily. But the mathematics don't support this consensus. The debt levels are unsustainable. The valuations are unjustifiable. The imbalances are growing larger, not smaller. When consensus views conflict with mathematical reality, reality always wins eventually. The question is just timing, and the answer is that we're very close to the point where reality reasserts itself. I want to end with something personal. I'm not sharing this analysis to scare anyone or to profit from fear. I've already built more wealth than I could spend in multiple lifetimes. I'm sharing it because I believe that understanding these cycles is crucial for anyone who wants to build lasting financial security. The patterns are clear if you study history. The opportunities are enormous if you position correctly. But most people will miss both the warning signs and the opportunities because they're too focused on the present moment. My advice to you is simple. Start preparing now, build cash positions gradually, research quality assets that you'd want to own at lower prices. Strengthen your financial foundation by reducing debt and building emergency reserves. Develop the psychological discipline to act when fear is at its peak. And most importantly, understand that what's coming isn't the end of the world. It's the reset that happens periodically in all economic systems. The investors who prosper during these resets aren't lucky or particularly smart. They're simply prepared and disciplined. They understand the patterns because they've studied history. They have capital to deploy because they built it during the good times. They have the courage to act because they've prepared their psychology for the moment when everyone else is panicking. This is your opportunity, not to get rich quick, but to build lasting wealth by understanding economic cycles and positioning correctly for the inevitable transitions. The 2026 crash is coming. The only question is whether you'll be on the side that profits from it or the side that loses from it. That choice is entirely up to you, And the time to make that choice is right now, before the crash makes it obvious to everyone else. Study the patterns, build your positions, prepare your mind. And when the moment comes, act with the discipline and courage that separates those who build generational wealth from those who watch it transfer away from them.